Gold and silver traded sideways to slightly up in price this week. Gold looks to be closing just under $1,230 per ounce, while silver spot price in US dollar terms is closing around $14.70 a troy ounce. With us this week, a gentleman who we last spoke with in early June of 2018. He is Christopher Aaron of iGoldAdvisor.com, and our gold and silver related discussion with him follows this brief message.
SD Bullion is pleased to offer Sunshine Mint silver and gold bullion products, either shipped fully secured discreetly to your door, to your gold and silver IRA, or to your direct non-bank storage account. All Sunshine Mint bullion products include an anti-counterfeit micro-engraving security feature. For more information on silver and other precious metals, visit sdbullion.com/education.
Welcome to this week's Metals and Markets podcast. I'm your host, James Anderson of SD Bullion. With us this week is Christopher Aaron of iGoldAdvisor.com. This conversation is being recorded Thursday, October 18th at 3 p.m. Eastern. Chris, thanks for coming on the show this week.
James, thank you so much for having me.
Hey, Chris, last time we had you on, it was early June of this year, and your message at the time, the prices of gold, spot was around $1,300 an ounce. Silver was around the mid $16 an ounce range. Your message at the time was, a little cautionary to beware of, the potential of spot prices falling, and indeed they did. A matter of a few weeks to a month or so later. And throughout the summer, silver spot hit a low right around 14, and gold obviously did something similar. So, I just wanted to congratulate you on giving a little bit of a heads up to some of our listeners out there and who might have taken advantage of that.
Thank you. I really appreciate that. Yeah, I do think that even for stackers, for the crowd that is looking at this from a long-term investment, of which I do with a portion of my capital, I want to make that clear. We do talk a lot of trends and a lot of charting, but I do believe in that policy for a portion of one's investments. But I also think that there is merit to trying to time some of the purchases sometimes, when we have one of these high probability kind of setups.
So I was looking at some of your recent videos. I think you did a video that you released on your free YouTube channel, which is excellent, by the way. I think listeners out there should definitely subscribe to it, iGold Advisor on YouTube. I was looking at the recent gold-silver ratio video you did, and then I went and looked. The gold-silver ratio today is, again, hovering over 84, which is kind of that multi-decade ratio high right now. So I think in the video you were talking about, next 6 to 9 months, it's going to be very important to see what happens with that ratio, how it plays out. So any thoughts you have right now on what you're seeing with that gold-silver ratio?
Yeah, so that's exactly right. And of course, just for anyone who's new to studying that ratio, the key takeaways to remember are that when the ratio is moving higher, in other words, when gold is gaining value relative to silver, that tends to be during times when both metals are actually losing value as priced in US dollars. And when the ratio is moving lower, it tends to be when both metals are gaining value as priced in US dollars. So now we're seeing there has been, as you mentioned, James, there's that multi-decade, literally this goes back to 2002. There is this zone between roughly 80 and 84 that has acted as resistance. In 2002, again during the crash of 2008, when both metals fell, that ratio topped out right around 84. This happened again at the 2015 bottom, exactly at 84. This happened again in that flash crash. Remember back to July of 2017 when silver dropped for 48 hours. And this level is being tested again right now at 84. And the common sentiment in the precious metals community is that, well, every time that the ratio has hit this 84 level, plus or minus, over the past 2 decades or so, has been an excellent time to buy. And indeed, that is right over the past 2 decades. But I just want to let people know that if this ratio does not come down, and we're looking at this window of the next 6 to 9 months, as you said, If this ratio does not come down, nothing is written in stone about how the markets have to play out. And if this ratio does not come down and it continues to kind of move even sideways in this zone and then looks like it wants to head above 84 and 85, it turns this entire 2-decade pattern that we're looking at of that resistance zone, it turns that into actually an upward biased consolidation, which means that the ratio would have a significantly higher target over the course of the next 5 or so years, and such would imply that silver would be losing a significant percentage more of its value relative to gold than it already has. So I'm not predicting that. I'm outlining the window that we are in right now. There's this 6 to 9 month window where this ratio has to break lower. Right now, the level to watch is roughly 78. If we can move below 78, especially on a weekly closing basis, I would get very aggressively long both metals, because I think then we're in the next rising cycle. But it really has to show itself.
Yeah, I'm looking at the 100-year chart right now, and if you look back, the all-time high of the gold-silver ratio was during the Great Depression, basically in the late 30s, early 40s, where it hit just over 100. And then you go back to the 1980 precious metal, bull market. For a brief time period, obviously the gold-silver ratio got real far down. It went down to the teens for a little bit. And then it, obviously in the bear market of the 1980s into 1990, you climbed back up, threatening almost 100 again. So what you're basically explaining is it sounds like if, say, we had some type of deflationary event, possibly where people look at silver and being like, well, no one's going to be buying silver because, how much stuff are we going to be making in this deflationary environment? I guess that's the argument possibly for how that could play out in the next few years to come. So it would have to be pretty deflationary, I would imagine. But obviously, like we said, it's
yeah. Let's just talk
Go
about
ahead.
that for one moment.
Sure.
Let's think about the broad stroke of history. When are the times that silver performs best? It's not during stock market crashes. This is the unfortunate reality. I've gone back and looked at the correlations between stock market downturns and silver prices, and really the only window in the freely traded era, of course, we have to be talking after 1971, because before then you had all sorts of price fixings in play. But really the only time that silver has been able to rise when a stock market crash is unfolding, there was a brief window during 73 to 75 where silver moved from about $2 an ounce to $6 an ounce as the stock market was in the bear market of the mid-1970s. Aside from that, think about 2000 to 2003. Think about after the dot-com burst. Silver did not move higher as the stock market was moving lower. Same thing, crash of 2008. So when does silver perform best? It's really when the stock market is stable, at least, and concerns start to manifest about the purchasing power of the currency. That's when silver really, really shines, not during a deflationary event.
Yeah, that I think is true. And when you were talking about that just now, I was watching it on the chart, and it definitely correlates with what my eyes were showing me. So moving on, I wanted to move into a video you did about the 38-year bond market, bull market that we've had. The questions are, I think, around the financial world are, is that indeed coming to a close? Or, what is going to occur with the U.S. bond market? Obviously, interest rates have been climbing. I think the 10 year is over 3%. Obviously, the 30-year, I think, is too. So what's your perspective? Obviously, this is a really, really large topic. There's been plenty of people who thought they could short the bond market, and obviously kept going for decade after decade. So what are your thoughts on that gigantic topic?
Yeah, really incredible topic here, and it's just going to be so fascinating. I think if you're a student of the markets and if you enjoy this type of thing, from especially learning about it, there's such a huge psychological component. What are the markets thinking? What are the markets almost feeling? And then how are they responding to those sorts of things? I think this is going to be an amazing time period to live through. Let's talk about it briefly for a moment from a technical basis, and then let's look at a bigger stroke of history with the bond market. I usually focus on the 30-year U.S. government bond, which is the longest duration bond that is issued for debt purposes. And the 30-year bond had been rising for 38. Well, it's technically still in this rising trend. It's right on the verge of this. And we will see charts of this. I'll provide those charts so you can look at this as we're talking about it. But there's this 38-year rising, very orderly parallel channel where bond buyers have been coming in every 2, 3, 4 years at higher and higher prices and bidding up the price of the bonds. And this has happened, mind you, this has happened during deflationary periods. People were buying bonds. During inflationary periods, like we saw from 2001 to 2011, people were buying bonds. This has happened during crashes. This has happened during bubbles. People just buying and buying and buying bonds. And we started to see these signs of a market that had taken on characteristics right before the Trump victory in 2016. We started to see a market that had taken on signs of a disorderly type of behavior. And typically when you have a long-term trend that then becomes disorderly, it starts to show you that the market is getting too irrational. It's getting too out of whack, and it tends to mark signatures of a top. And so right now, when we look at the 30-year bond price, we are right at the edge of the lower 38-year trend for the bond price. And of course, interest rates move opposite to the price. So when we're talking about the bond price moving lower, and testing this key support, what we're talking about is interest rates testing a key resistance. I would say the level to watch right now is right around 137 on the price of the bond. And if we crack below that level under this model, it indicates that the top has been put into place for the price of the bonds, and therefore interest rates have the potential to be rising really for a generation ahead. We could be looking at a generational rising cycle in interest rates.
Yeah, I mean, that's really important, obviously, when you're in the whole $21 trillion in debt as far as the federal government's concerned. And if you start to think about the unfunded liabilities and how large of a pile that is, some of estimates are over $200 trillion. You start to think about how is that going to be paid if interest rates keep rising and keep rising. Now, obviously, the Federal Reserve has been rising rates, I think, to have some ammo in the next recession to perhaps be able to cut them and to perhaps ease the pain of the recession that may come, because obviously we're in one of the longest cycles that we've ever had as far as stock markets going up. So and it's getting very political too. You have Donald Trump out there who's very happy about the bull market in equities and how high the prices of equities are. And simultaneously, you have Jerome Powell and friends at the Federal Reserve who've been raising interest rates, and it looks like he's preparing to have a fall guy. If let's say the recession comes about, he can point and say, "Look, it's because the Federal Reserve kept raising rates." I mean, obviously, I think
Exactly
a lot of that is political, but it's just. Can you even imagine like what our society would look like if we had, say, double that, maybe triple that? Say interest rates were 6% or 9% with that kind of debt level. How expensive that would be for the federal government? How would it operate? How would it pay for its bills? Obviously,
it's going to be an incredible. You're right, James. It's going to be an incredible time to live through, and I want to provide this chart also for just a bit more historical context. When we look at the 10-year, we're talking now the 10-year Treasury note, we have data dating back a lot further than the 30-year. And I'm going to pull up this chart. You'll be able to see we have 10-year interest rates going back to the 1870s. And what's absolutely unbelievable, if you think about this for a moment, is that interest rates, and pretty much the same trends are applicable for the 10-year and the 30-year. Even though the 30-year is a lot longer duration, they tend to move in the same overall direction, both higher and lower. The recent lows that we saw on the 10-year just about a year ago, under 2%, were lower. These were the lowest interest rates on the 10-year of all time, ever in the history of record keeping that we have back through the 1870s. Even lower than the level that was hit in the early 1940s. And think about what was happening in the early 1940s. After the stock market crash of 1929, the bubble in which the stock market then lost 90% of its value over the next 3 years, which drove a lot of money into bonds seeking safety. So you had 10 years of the Great Depression, 1929 through 1939. Then you had World War II, in which the general population and the Federal Reserve were both buying bonds and thus suppressing interest rates based on a sense of national duty and also, needing to do that to finance the war effort. So what I'm saying is interest rates were just lower 12 months ago than after the combination of the Great Depression and the largest international conflict in human history. Yet we had neither of those two things bringing interest rates that low. So what was going on over the last decade or so was something so out of whack, I think, with true fundamentals that I think the reaction in the opposite way is going to be a sight to behold when it really starts to pick up speed.
Mm-hmm. Yeah, and the only question is, if that is indeed the case, what will be the intervention? Because just based on our history that we just talked about, that they always come and intervene at some point. And so exactly what will that look like, right? It's just, there's absolutely, I give it very little chance that the Federal Reserve will stand hands back and let a lot of the companies that, possibly could go under, allow them to go under, so it's just a question of how that will play out and what interventions will come.
That's right.
So yeah, the idea that, in the early 2020s, potentially, you could have a situation where you have both U.S. bonds and potentially the U.S. stock market going into recession. I don't think, either you or I have never lived through that. I think the last time that occurred was in the 1970s. I think I just recently interviewed with Jim Rogers. I tried to get a little bit out of him what that was like, and he maintains, he maintains still that the U.S. dollar is going to have one more pop higher, and he thinks that he'll get one more chance, or he hopes he'll get one more chance to possibly buy gold at a lower price than it is today. But what are you thinking in terms of the early 2020s and the potentiality of seeing both those? They're very, very large asset classes. The U.S. bond and U.S. stock markets are, you're talking hundreds of trillions of dollars in them. What would that look like, or do you even expect to see that, or what are you thinking in those terms?
Yeah, this is the great macro setup that I think is brewing, and unfortunately these huge setups can take longer to come together than sometimes would be convenient, for investors who want it to be right here and right now. Mm-hmm. And so fascinating interview must have been with Jim Rogers, and anyone who lived through the last great interest rate rising cycle of the 1970s, where, yes, that was the last time that we had a stock market. As a net sum, the stock market didn't move anywhere from 1959 through 1982, and there were several 40 to 50% mini crashes in that whole period. So stocks were selling off, bonds were selling off. Basically the bond bear market began right at the peak of World War II in the early 1940s, and bonds sold off until 1980. So there was a multi-decade bear market in bonds, a multi-decade bear market, if you will, in stocks at the same time. And this was the backdrop, if you think about it, this was the backdrop of the precious metals bull market of the 1970s. Now, if you think about one other thing, though, this type of backdrop, we just said the bond bear market began in the 1940s. The stock bear market began in 1959. It wasn't for another, decade at least that we saw the precious metals start to respond to that pressure, and the perking up in the international market in the late 1960s, where gold in the international market started to be sold for higher than the official price that was set by the U.S. government. The price of gold was still set at $35 an ounce in the late 1960s, but sales were actually happening at $41, $42, $45 an ounce.
Right.
Until Nixon was forced. It's not that Nixon just was necessarily such a bad guy. He had his problems, of course, but really the market imposed on him. The international gold bullion market imposed the severing of gold to the dollar based on these decade and multi-generation types of trends in the stock market and the higher interest rates. So what I'm saying is that we are seeing that same setup just beginning now. I mean, it looks like the bond market just topped 12 to 18 months ago, and this thing could be rounding out and moving higher for some decades ahead. And we'll see what happens with that intervention when, of course, as you said, it's going to happen. They're not just going to let the bond market get out of control. Mm-hmm. So I think the challenge is that we can see these trends start to play out, and it's almost like the precious metals are being quietly accumulated by those who see the direction that it's eventually going to go, but their actual prices can remain in a downtrend even as those long-term plays in interest rates and stocks are setting up. And I actually believe that that if the stock market, if the bond market has indeed topped, that some of that liquidity is going to move into stocks in a final blow-off type of phase, which I do not believe is actually here yet. And I think if that happens, it may suck into it a lot of the liquidity initially, as Jim Rogers was saying. It may suck into the stock market and cause kind of a final low to form in the precious metals, which may not be still for a couple more years. This is the broad scenario that I think has the highest probability of playing out. Of course, I don't want to get married to that narrative. I want to observe these markets as they develop in front of us and be prepared to respond if we see certain levels in the precious metals accelerated and taken out quicker than I believe.
Sure. And backing off, we're going to move on, I think, to something that's a little bit more industry specific. You released a video real recently, I think it was this past week or 2 weeks ago, about the COT Reports. If you wouldn't mind giving our listeners, I'm sure they've probably seen this, what COT Reports are, and then just a general overview of what they are and kind of what your takeaway is about COT Reports this day and age, and about how valuable those are to look at.
Yeah, and I'll pull up this chart too for everyone who's listening. It's a little bit complex when you look at it, but I'll just try to go through it as clearly as possible. General takeaway: the COT, the Commitment of Traders Report, is a report that's released by the CFTC here in the United States. It's the governing body for commodities trading, and it simply lists the open interest. In other words, how many contracts stand to be open at any given moment. Futures contracts we're talking about, and it exists for gold and silver and every commodity. We're focusing on gold here. So we're talking about how many contracts are open, and then the categories are divided into several different categories, producers, hedgers. But generally for our purposes, and what I see most precious metals analysts focusing on, is the divide between the commercials, which are generally users, hedgers, and producers of the metal, and then this category of speculators, which are individuals who are looking to profit based on the price moving higher or lower. And there's a misunderstanding, I would say, about the relevance of the COT report. And most people who I see analyzing the COT report go back to the bull market from 2001 to 2011, and they look at the position of these speculators versus commercials. And if you go back to 2001, this is shown in the green highlight that I'll show on the chart here on the far left, the first green highlight that you will see. It shows that the last time that the commercials were net short, the commercials were net long, meaning they thought the price was going to rise, and the speculators were net short, thinking the price was going to fall. The last time this happened was in 2001. And so a lot of people are looking at this and saying, well, think about that. That happened in 2001. That means, therefore, this is happening again. Maybe we're setting up for another 10-year move higher in the price of gold. The problem is that I actually believe they're just not looking at enough historical data. So the chart I have goes back to 1993, and James, I believe you have a chart that goes back through the mid 80s.
Mm-hmm.
When we look at, and as a general principle, this goes for all markets, but the signals that are applicable, the signals that work during a bull market, do not work during a sideways market or a bear market, which we've been in for the last 6 years here in the metals.
Mm-hmm.
And so when we go back and we look at the same signal, we're talking speculators net short, thinking the price will fall, and commercials net long, thinking the price will rise. We also saw this exact same signal back in the late 80s, and you'll see this signal on my chart, for example, in 1994. And of course, what happened after 1994 is that gold and silver, for that matter, declined for another 5.5 years, till that low in 1999. And so I am just sort of talking about this type of analysis. This doesn't mean that the metals have to fall again for another 5.5 years.
Mm-hmm.
Nothing's saying that. But what I am trying to alert people, because there's this almost universal belief that because the commercials are net long now and the speculators are net short, therefore the price is putting in a major low right now.
Right.
And what I'm saying is the data does not show that when we look at history.
Yeah, I mean, I'm looking at that long chart that goes back to the mid 80s, and you're talking about from the mid 80s till about 2000, you had the commercials and the speculative class, basically like a baton going back and forth. When one group was net long, one group was net short for long spans of time, sometimes for years. And there's really no causation or correlation between what they were up to and what was going on with the price at that time. Now, if you look at 2000 to 2011, the speculative class that was net long, those guys were the smart money. And now, since 2011 till today, they're referred to as the dumb money. And it doesn't make a whole lot of sense because they were definitely winners for about 10 years there, and now all of a sudden they're dum-dums. So this trope, I think, that's out there, it kind of oversimplifies things, I think. And I think it's a little more complex than that, especially nowadays when you have derivatives in large, ETFs like GLD and SLV. It's very difficult to know necessarily where these various investors or commercials are investing and where they're exposed to as far as precious metal prices.
Yeah, James, so just as a corollary, in addition to that point that you just made, the reason I actually, as of about 6 months ago, I hadn't gone back and parsed all that COT data. And I had seen these arguments, these articles and videos being written on the COT, saying, look how bullish it is, look at the situation that's developing. And I saw that type of analysis increasing in intensity and in rhetoric over the last 6 months as we've gotten to this situation of the net longs and the commercials and the net shorts and the speculators. And I would just tell everyone out there, if you're following the precious metals market, you must be a contrarian to some extent. You're paying attention to a market that probably 1% only of the United States or the Western world is investing in at this point. So you are a contrarian. But then what I would say is sometimes you have to be a contrarian amongst the contrarians. And anytime that you start to see one argument, and so for me, it was all of a sudden my sort of contrarian bell started ringing in my head about 6 months ago. And I was saying, I'm just seeing way too many articles that are telling me that this is the most bullish signal that there could be based on this COT report. And I said, something is not right. Too many people are believing this story. I have to either confirm or negate this for myself. And so I want to encourage listeners to do that for themselves. Anytime you hear one story being really universally believed out there, no matter which way the story is going, I would just say, raise your sign of caution and investigate these things for yourself.
Mm-hmm. Yeah, it's a really good point. I think often you see here where the precious metals market is very small, and there's only so many people out there in the public space who are actually commenting on the market itself. what you'll see a lot of times is people will try and break a story, and then a whole bunch of people will just repeat it. They'll just basically copy it and put it in their words and pass it off as if they did some type of analysis. And that's that happens all too often. And a lot of times those stories or those forms of analysis, they fall short looking backwards. You can see a lot of times that happens. So I think your words are well spoken and to the wise. I think anyone who's in this market for the long haul should be should do their own analysis as well as listening to others and confirm it or deny it based on their own.
Yep, exactly right.
So Chris, to close it out, obviously we're nearing toward the end of this year. It's amazing. 2018 is getting toward the end of its time cycle. 2019 is going to be here before we know it. We'll be in the middle of winter. There's a lot of things that are going on in the world, and it's the strangest thing because some of the headlines that you're hearing now are crazier than ever, and it's like the boiling frog thing where you're kind of in the hot water, and the water keeps getting hotter and hotter, and all of a sudden it's like you don't even realize how nutty some of the stories are and how big some of the stories are. So just to throw it out there to the listeners, what are the major macro stories that you're following right now? Maybe what are some of the key things that you're really keeping your finger on the pulse for moving toward the end of this year and into the next?
Biggest thing that I'm watching is think about what happened last week. This is what I see is that we're seeing tremors. It's almost like there's an earthquake that is being predicted. It's been predicted for a long time, but we're actually starting to feel some of the tremors of it. And what I mean by that is if you think about what happened last week, it's the same causation that I saw in February of this year when we had that sort of mini stock market panic back in February. It was the exact same chain reaction that happened where the bond market was selling off, and we're talking about the potential for that sell-off to accelerate in a generational kind of top here over the next year or so. The bond market was selling off. The stock market was essentially whistling past the graveyard, completely ignoring what was happening until the sell-off reached a level of intensity where all of a sudden then several weeks later, the stock market panicked and said, wait a minute, these rising interest rates are going to affect corporate profits and individuals and government's ability to borrow. This is going to affect equity values. And then all of a sudden the mini stock market panic happens and suddenly people are paying attention to interest rates. So what I'm saying is we're seeing the tremors. I think this is the major macro picture, a major macro point for people to be monitoring, because if we see then that generational top in the bond market form, I think within the next few years is going to be the point where it goes from, these little tremors to a major trend that we have just seen the initial warning signs for. So I would just encourage people to pay attention to that relationship between the bond market and the stock market, and then consider where the precious metals may be when that starts to accelerate.
Well, Chris, thanks so much for coming on again. I definitely hope to bring you back maybe sometime in 2019 early on so we can continue the conversation.
I would love it. Thank you very much, James, for having me on.
All right, Chris. Thanks to our listeners out there. We'll see you next week.